Hello everyone, a very good morning. Welcome to Oliveboard. This is the JIB Foundation May 2025 series for the RBWM paper. Today we are going to cover the unit 4 from module A, which is branch profitability. The first three modules have already been completed and they're there on the YouTube channel. If you haven't yet seen them, make sure you watch them. Also, don't forget to subscribe to the channel so that you do not miss any of the updates. Now, when we talk about branch profitability, in this particular chapter, we are going to study the difference between profit and profitability. Then we will study what are the traditional methods of profitability, like the return on assets and return on equity. Then what are the factors that affect the profitability of banks? What steps the banks can take to improve their branch profitability? All right. So let us begin with first understanding the difference. When we talk about profit is a more quantitative term which refers to the money that a business pulls in after accounting for all the expenses. So basically it is the difference between the income of his business and its total costs. So profit refers to the total revenue minus total cost, the money that remains with us after we have accounted for all the expenses. That is the profit. However, profitability is different. It gives us a more holistic view of the performance of the bank, right? So profitability is the relative measure of profit. What we are doing, we are comparing. It compares how much profit a company makes compared with its overall revenue and costs. With every additional cost, am I deriving additional profit as well? Or to derive 1 unit of profit, I am putting in more costs. So that is a comparison that we make. So profitability is the ability of a business to generate profit or the efficiency of a business in generating profit. So it refers to the profit divided by revenue multiplied by 100. So it is giving us the profitability percentage. All right. So now there are three major types of profit, which are the gross profit, operating profit, and net profits. This is the most important topic of this unit. The three components or three types of profit and what all are included. Now let us see. The first level of profit is the gross profit, in which the sales minus the cost of goods sold is there. So sales minus cost will give us the gross profit. This is the foremost or the first level of profit that we derive. All right. So gross profit is equal to total sales minus cost of goods sold. If let's say the company had total 1 lakh rupees in sales, right? And the cost on goods sold, let's say that was taken, was let's say 20,000. So we will subtract it and we will derive the gross profit. All right. Then the second level of profit is the operating profit, which is calculated by deducting the operating expenses from the gross profit. So to derive at the operating profit, we first need to calculate the gross profit. Then we will deduct the operating expenses. So the gross profit looks at profitability after the direct expenses, and the operating profit looks at profitability after the operating expenses, like costs incurred on the selling, the general and administrative costs. These are the S, G and A. The S, G and A. So again, from the gross profit, we will subtract or deduct the costs incurred on the selling, the marketing of the administrative costs, and we will derive the operating profit. We can also derive the operating profit margin by dividing the operating profit by the total sales, by the total sales. So we can calculate the operating profit margin. And then the third level of profitability is the net profit, which is the income which is left after all the expenses, including taxes and interests that have been paid. So interest and taxes, these are also expenses which have to be incurred by the bank. So when we finally deduct all the expenses, then the income which is left is known as the net profit. All right. Now, when I'm using the terms profit and profitability, so there's a difference between the two. Profit is the absolute number which is determined by the amount of income or revenue which is left beyond the cost and expenses. Profitability means that we are trying to understand the scope of a company's profit in relation to the size of the business. All right. So we can say the ability of a company to produce a return on the investment based on the resources, that is profitability. Now, here the difference between the gross profit, operating margin, and net margin is given. So from the income statement below that, we have the cost of revenue minus the cost of goods sold will give us the gross profit. Subtract from it the operating expenses will give us the operating income. From that, we subtract the non-operating income or expensive pre-tax income minus the income tax. Finally, we will derive at the net profit or net margin. All right. Then when we talk about the measures of profitability, so there are two traditional measures of profitability. We have the return on assets and the return on equity. When we talk about the assets of a bank, so the assets include the liabilities plus the bank's capital, right? So assets are used by the business or the banks to generate income. The loans and securities are the bank's assets and they are used to provide most of the bank's income, right? So assets are the liabilities plus the bank's income. Now, when we calculate the return on assets, there's a formula which is used, that is the net income divided by the average total assets of the bank. Return on assets assesses the profitability of a firm against its total assets, signifying how efficiently a business uses its assets for generating profits. So, there are certain components of the return of asset. It depends on the net interest income. Basically, net interest income means income, the interest which is paid, the difference between the interest which the bank has to pay on the deposits and the interest that the bank receives on the loans. The interest that they receive on the loans. This difference, if it is positive, then we will say that the bank's net income is more. So the net interest income depends on the interest rate spread minus the interest rate which is paid on the liabilities. All right, that is the net interest income. So interest received on assets minus the interest which is paid on liabilities will give us the net interest income. And from that, we are going to calculate the return on assets by dividing this net income from the average total assets. That is a simple formula for it. All right. Then second measure is the return on equity. The return on equity is what the bank's owners are primarily interested in because that is the return that they earn on their investment. The return on assets is the basically the difference between the interest which is paid by the bank and which is earned by the bank. But return on equity, equity means the investment that is undertaken and what profit are we deriving on that equity or that investment. So it depends not only on the return of assets but also on the total value of the assets that earn income. The total value of the assets that earn income. So when a bank increases its liabilities to pay for its assets, it is using leverage. Otherwise, a bank's profit would be limited by the fees that it can charge. So just charging the fees on the loans or other products and services cannot generate enough income for the bank. So they have to resort to equity as well, right? And whenever they're using their liabilities to pay for assets, it is using leverage. All right. So the return on equities formula is the net income upon the total average total equity. The average total equity. We can also derive the return on equity by multiplying the return of assets into the leverage ratio. The return on assets multiplied by the leverage ratio. The return on assets, the formula that we already know, the net income divided by the bank assets. Leverage ratio is the bank assets divided by the bank capital. Let me just write it down. The return on assets formula, which is net income divided by the bank's assets multiplied by the leverage ratio, for which the formula is bank's asset divided by the bank's capital. Bank's capital. We can simply cancel this out and the return on equity will be the net income divided by the bank capital. So this is the return on equity formula, right? When we are talking about this leverage, so the leverage that the bank is using is similar to a business that is using debt to increase its earnings, right? If it is using debt to increase its earning, it is not going to be profitable, right? So similarly, we can say the leverage ratio is same as the debt ratio, which is used to determine the leverage of other business types. All right. So that is why banks must manage their risk very carefully to earn profit. Next, we talk about the branch profitability. How can banks manage their profitability and efficiency? So efficiency means that if the bank is making any investments, they are generating positive returns out of it. So, a balanced approach would be one that enables a bank not only to improve its operative efficiency but also to upgrade its capabilities for, let's say, to respond to the market needs, prepare for the future. This will include the training which is provided to the staff, leveraging or using the new technology, the digital services, catering to the changing demands of the customers in the present scenario, right? So efficiency is very important. Here are some best practices for the banks. Standardize the cross-checked practices, train the bank staff, educate the customers about the new products and services, implement the technological solutions, encourage online banking, collaborate with the regulatory authorities. These are certain steps that the bank can take. They can uh, they can involve in business realignment. The bank's business realignment means exiting the business lines that have low margins and rather move into the lines which are more cost effective and they increase the bank profitability. Then channel optimization is important, both the physical channel and the digital channel, because a mix is preferred by the customers because of multiple channels, multiple delivery, multiple products and customers. So channel optimization, making the channel more user friendly is important. Then process cost, banks should improve the process cost, reduce the costs that are incurred on providing or delivering the service. Staff productivity, training the staff, how they can interact better with the customers. They can understand their motives and their conditions and provide the adequate product and service. Technology and automation, vendor management, innovative reward design, automating customer care, digital revolution. All of these steps are important. Again, dynamic pricing, cross selling, and upselling can increase the profit and efficiency. Customer loyalty programs, so that the customer can be retained for more products. They do not move to another bank for availing, let's say, an insurance product or a pension product. Expanding the service offerings, optimizing the branch operations, strategic partnerships, digital marketing, community engagement, data driven decision making using AI, machine learning, and big data analytics, innovative technology. These steps can be taken by the banks to improve their efficiency. Now, there are certain factors which affect the profitability of banks. Some are very general, which are the macroeconomic factors like GDP fluctuations, inflation, then the monetary policy, if RBI takes a step to lower the interest rate, plus the stiff competition. Then there are some industry specific factors like NPAs. Then NPAs, they reduce the profitability. There's increasing operating cost, decline in the interest margin. Other bank specific factors are also there, like capital adequacy, operating costs, operational efficiency, service charges, fees, guarantee fees. These are the factors that affect the branch efficiency and profitability. So again, we have already discussed the steps that can be taken to improve the branch profitability, focusing on the balancing profit, growth and risk. Strategic fit should be taken. Customer centric approach should be taken for each branch. Then better opportunities, entering into market segments that have more income generation. They are less cost, they are basically cost effective. Analyzing the competition, setting specific goals, marketing campaigns, redefining the bank model for the future if necessary. So these steps can be taken. And that is all. So this chapter basically focuses on the profit and profitability and efficiency of the bank branches, how they can improve it, the steps that can be taken. When you study this chapter, make sure that you understand clearly the difference between profit and profitability, the traditional methods, and what all changes need to be made in the retail banking segment. Now, if you want to join the JIB selection batch for the May-June 2025, it is an all-in-one course where under the single course you will get the preparation notes classes for all your papers, 250 plus live classes covering the papers, full length sectional case study and numerical based test, and you will get your preparation from complete basics to the advanced level. It is going to be a live batch. All the details are available in the description box, so you can enroll from there, and you can also download this PDF. The link is also available. So thank you so much for watching. These videos are very important. They will give you a clear idea of the unit, the topics under it, and make sure that you watch all of them and you subscribe to the channel so that you do not miss any of the updates. If you have any doubts, any queries related to this unit or related to course or anything, you can let me know in the comment section. Thank you so much. I will meet you again with the next unit. Till then, all the best.